Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm E-BVictory. Today's December 2nd, 2022. It's day 2 of my 31-day reverse mortgage challenge, where I stated yesterday that my goal is to make one video a day for the entire month of December, covering different topics regarding reverse mortgages. Yesterday, we started with the concept of how for some people, the idea of foreclosure and reverse mortgages seems to be tied together in their mind. And this has to do with back in the day, before the changes, where all the money was given to the borrower in one lump sum. And by using all the money, they wouldn't have money to pay for their property taxes. And what I covered yesterday is the reasons that a property can go into foreclosure. And one of them is the fact that if you don't pay your property taxes, and that's, if you think about it, even if you don't have a mortgage on your property, the county or the state will put liens on the property to ultimately foreclose on the property and be reimbursed for the owed property taxes on the house. Now, yesterday what we talked about is for you to really get the benefit as a viewer, as someone who's interested in doing potentially a reverse mortgage, and to have this exercise, this video today and yesterday be meaningful, for you to come along on this video and do the exercise and write down and use your information. Because I said, if I use hypothetical numbers or numbers that belong to another client, that's really not going to be an advantage to you, because you're going to say, I stacked the numbers in favor of a reverse mortgage, and then it's going to really serve no purpose. But if you take the time and the effort and you do the exercise that I'm suggesting, and you put this information together, then you really are going to see a significant eye-opening experience towards the benefit of a reverse mortgage. These videos that I do are not just educational in nature, but these are the same conversations that I have when I sit down with a client in the office with their financial advisor or their adult children. So what you get here is literally all the steps that I go through, the conversations, and how deep I go in trying to show the consequence of what a reverse mortgage is going to do. If we just have superficial meaningless conversations, and you see the same thing as you see everybody else rehash over and over again when it comes to reverse mortgages on YouTube, there's really nothing that's being brought to the table, and most of all, there's no advantage to you. My goal and my hope is that through these videos, you have a different perspective and a mental shift, and you really challenge yourself to see beyond where you're seeing the limitations and see the overall value of this product. Obviously, if you want me to help you and I could do the mortgage for you and assist you with a reverse mortgage, I would love to do it. But if you, for whatever reason, choose to go with somebody else, I don't feel like anything is wasted, because ultimately, if you have a better quality of retirement and these educational videos were a cause of that, I'm delighted, and that's all that matters to me. So we're going to pick up today where we left off yesterday. And what I said to you is that if you do some preliminary research and find out some information about your own existing mortgage, then what we're going to do today is talk about you and your spouse's monthly stream of income and look at the reserves. And between the mortgage piece of it and your income piece of it, we're going to come together and we're going to do a compare and contrast between what the retirement possibility and picture looks like with a reverse mortgage, and if you continue on your existing path of having a forward mortgage. So where I want to pick up today, and what I would encourage you again, is to grab a pen and a paper and write this information down. There's a lot of information behind me, and I know it's difficult to read it, but I'm going to go over it post by post, and you can write it down, and you could always take a snapshot of the board and enlarge it to see what I wrote down, but we're going to go over it. So there's a lot to cover, and I want to give you really the benefit of everything that I discuss when I meet with the client. So what I've started is we have the monthly income, and this talks about the sources of income that you and your spouse get. And if you notice, I broke it down so that there's the husband section and then there's the wife section. The reason I separated them is that there's some incomes that once a spouse passes away, or if they go into a long-term care facility, you no longer get the benefit of that income. And it's important for you to separate what the source of income is and how much that income. And the way I do it is I separate it so that first we have the top line, it's Social Security. Each person is going to get it. So we have his and hers Social Security, his and her pension, and his and her other. And that other can really be personal and applicable to you. It could be rental income that maybe you're getting from a rental property that you have. Maybe it's a stream of income from some sort of a business affiliation and you get some sort of monthly income from it. Whatever that is. But ultimately, I want you to separate yours and your spouse's income and delineate where it comes from so that we can see what the likelihood of it continuing is if that other spouse, God forbid, is no longer in the picture. So we have a total for the husband, we have a total for the wife. The next line item that I want you to care about and write down is savings account, which is, I think of savings as literally cash, dead presidents. It's what you have in your savings, is what you have in a CD. And then you have your investments, and the investments could be a little bit broader, and that could be your IRA, your Roth, your 401, your money in a money market, stock account. It could be things of that nature. And then again, I have other, and that other is again applicable to what your situation is. Maybe you have commercial property that's worth $1 million and it's free and clear. Well, obviously that's an asset that could potentially be liquidated. And again, the other is there just as a mental reminder so that you account for everything. My goal is really to try to establish not only your sources of income, but your current reserves and how much you have. Okay. Now, once we establish the income and your basis of reserves, what we talked about yesterday is that you have a mortgage, you may have potentially a home equity line of credit, a HELOC, one or the other, you may even have both. And what we talked about and what we're going to do today and we're going to pick up is we talked about your current mortgage for your housing. And your monthly mortgage payment, whatever that is, you want to write that down so that we know how much your monthly mortgage is. We want to know what the balance is right now. In other words, if you win the lottery and you were going to pay off your entire mortgage and you contacted the company, they would tell you, Mr. and Mrs. Smith, right now you owe $200,000. If you're going to pay it off by January 11, that'll be $203,000 with prepaid interest and all in. So you write them a check tomorrow for $203,000 and your mortgage is paid off. That's what I mean by balance owed. That's one number that you need to know. And we talked about that if you have a situation where your property has a mortgage and it's going to be paid off in 3 years, in 5 years, 7 years, 10 years, you want to know how many years are left. And the reason you want to know is that the figure of what the payoff is in this number, if you were going to write the check and send in a check tomorrow, is going to be a completely different than what the number is when you have the total interest calculated for a mortgage that you have 6 or 7 years left. And that's where getting a mortgage calculator that has an amortization schedule and you put in your numbers can be helpful. And the reason I suggest finding this number, the total number, is that you may not be in a situation where you're going to pay off the mortgage and to have the house free and clear, but you do need to know an accurate number that reflects the total amount of money that you would have spent in the course of paying off your mortgage 4 or 5 years from now. So once we have what this section looks like, then the question is, do you have a home equity line of credit? And again, for some people, they may have one or the other or both. And for the home equity line of credit, we said the conversation is very simple. A home equity line of credit, the first 10 years, it allows you to make an interest-only payment. And after the first 10 years, now whatever the balance is, the line basically is closed to you, and you're going to have to pay principal and interest payments for the next 15 years in order to pay off the balance. So if you have a home equity line of credit, we need to know, are you in the first 10 years where you could pay interest only, or are you in the second half, which is the 15 years where you have to pay principal and interest? Now, obviously, you need to know what the balance owed is, because if you both have a first mortgage and a HELOC, you need to know and incorporate this balance into your housing cost. So once we know what this top section is, these two tiers are, now we know what your mortgage situation is. The third category we talked about are the expenses that come along with the joys of homeownership. It's your property taxes, and we divided it by 12 months, and it gave us a figure. It's your homeowner's insurance. We took it and divided it by 12 months, and that gave us a figure. And we said in certain situations, some people that live in condominiums or planned urban developments have homeowner associations. And that is a homeowner association fee that we put in there. So if you notice this box, I put it in here because it's independent of the mortgage piece. So that even if you pay off your mortgage and there is no mortgage on your property, this cost still continues. It's your property taxes, homeowner's insurance, and your HOA. And that's something that you're going to have to do no matter what. Yesterday, we also talked about another category of debt, which I called soft debts. Okay, so these are soft costs, and they have to do with what it takes for you to be able to live in your home. And it could be as expansive as you want, but at a minimum, you need to have your gas, your utilities, your Department of Water and Power. If you have gardening service, if you have pool service. Now, if you want to be more expansive and put home internet, home cable, home cleaning crews. You know, if you really want to drill down and put all the costs that you know you pay for every month that you're going to have and it's going to be ongoing and you depend on, if you really want to be accurate and more detailed, you could include those in the soft costs. But that's basically where we're at. So once you have the income and the savings calculated, and you have the mortgage and the home care costs put together, this is where the difference in having a mortgage that's either a forward traditional mortgage that you have right now or a reverse mortgage, which is what I'm a proponent of, really shines, and you get to see the difference. And all the stuff that we've done and the numbers that we put together, this is where we bring them together and we marry them. And if you think about it, it will really begin to show you what I mean. So if we're talking about a monthly mortgage payment, and let's say very basic number, $2,000. If your monthly mortgage payment is $2,000, and for right now we'll assume that you don't have a home equity loan. So if you don't have $2,000, if you have a mortgage payment that's $2,000, then you don't have a home equity loan. Then we come on this side and we look at what your monthly income is from the different sources that you have, how much you have and how much your spouse has, okay? And the first question that I ask you is, how much of your monthly income is being used to pay this monthly mortgage payment? So that's very case specific to you, and this is what I meant by yesterday and why I repeated it this morning, that it's relative and it's important for you to use your numbers, because your numbers are going to determine how much of your income is going towards your monthly housing. And that's just your monthly housing, that's just your mortgage. That's not dealing with this stuff. So we're just going to leave this alone for right now. So if you tell me that my spouse's and my Social Security income is $3,500 and $2,000 of it is going to just pay my monthly mortgage payment, well, that's a problem, because if you also tell me that you have 8 years left on your mortgage, God forbid something happens to your spouse or they need to go to a long-term care, immediately and effectively, you're going to lose that spouse's monthly income. And depending on what these other sources of income that you have and are relying on, they may or may not be affected. Because let's say, for example, husband passes away and his Social Security is now gone, his pension is a contractual obligation, it may be gone as well, and let's say there is nothing else. So yes, if his Social Security was higher, the spouse can get the husband's former higher payment, but she's still not going to be able to get her current Social Security. In other words, you don't get to double dip and have two Social Security incomes. You get a step up and you get that other spouse's Social Security. But the question becomes, is that enough to make up for all the other income that the spouse was bringing in, who's now not available, and his income is gone? So that's the first part, and that's why it's important to break it up to see the different categories. So how much of the monthly income that you're getting here is being attributed and going towards this mortgage payment? Now, for some people, their idea is that I have a $80,000 mortgage balance and I'm going to pay that off. I'm not going to continue making mortgage payments. I'm going to have my house free and clear so that I don't have a mortgage payment. Okay, so how much of your savings would be gone if you pay off the balance of your mortgage tomorrow, whether that's a first mortgage or home equity line of credit? Well, that has to do with the second category of your reserves and savings that we talked about. And you know what that money is right now. You could tell me within, a couple of $1,000s maybe, of how much your total money is. Now, if you're going to reduce your savings, your overall savings, by the amount of your existing mortgage, suddenly how much of your savings is completely gone in order for you to have a house that's paid free and clear? And that portion of your savings that's gone, okay, is it going to cause you to lose more money in the future because it's not in the market and can't grow and can't generate investments? By using it, are you going to be subject to capital gains taxes or income tax bracket changes because of maybe the way it was invested? Maybe it was pre-tax money that by taking it out to pay off your mortgage, you're going to have now tax obligations? Are there going to be early withdrawals because you didn't meet a certain age restrictions and you took the money out sooner, and now in order to pay off your property to be free and clear, you're going to have tax obligations? In other words, there's consequences to the decision of I'm going to pay off my mortgage, not only just in paying off the mortgage, but there's consequences in terms of how I use the money and where I got the money from. If you decide to go in the category of not paying off the mortgage in one lump sum, and let's say your mortgage is going to be paid off in 8 years, well, we've already established that there's a prepaid interest calculated to your balance, which if you amortize it over the next years, it's going to be higher than what the balance would be if it was paid tomorrow. And now the question is, you're going to continue making monthly payments, and let's say your spouse is alive, so you do have this income. But at the end, you still have to pay a higher amount, including the interest. And I'm talking about that total number. In other words, if it was $200,000 tomorrow in 8 years, if you pay it off, maybe we do the calculation and it turns out to be $250,000 that you've paid in the course of the last 8 years. So again, the property is now paid off, but installments. So the question becomes, once you pay off and you have zero access to the biggest retirement, which is your housing wealth, you took 8 years, you paid off the prepaid interest, now you have your house that's paid for and free and clear. But your house is illiquid. It's this big box that you live in, and when you need money, what are you going to do? Now you're down the road, you're on a fixed income. Maybe your spouse has passed away, so your income is even less. And when you need to go get either a home equity or a mortgage, the bank approval is going to say, Mr. and Mrs. Jones or Mrs. Jones, you're on a fixed monthly income, and the amount of money that you want has a income requirement that you don't meet because you don't have enough income. And your other alternative is that you do get the mortgage, whether it's a HELOC or a traditional mortgage. Well, that mortgage or HELOC is going to generate a monthly income. And again, you're on a fixed monthly income, whether it's both of you or one of you, but at some point one of you is going to pass away. And how are you going to make this monthly payment on this new mortgage that you got after you paid off your property, whether now or 8 years from now? What I'm getting at is that we keep coming back to the same issue, which is if your mindset is that I don't want to incorporate the biggest tool that I have in my retirement, which is my housing wealth, and to be able to access and use a portion of my housing wealth to help me, you keep running to the same issue of, are you going to have enough income generated every month to be able to afford not to touch your house? Do you have enough reserves after you pay off your mortgage that you can afford not to take another mortgage? Maybe if you have $10 million or $3 million and your cost of living is, next to nothing, and you have enough money coming in, that's the situation that you're in. But I can tell you that the people I meet with, the seniors that I discuss the topic with, and the reason I'm going so far in depth on this is that you understand this is the bigger picture. This is the landscape. So when you just think about, I'm going to pay off my house and that's the end of it, no, that's just really the beginning of it. Because once you pay off the house and it's just sitting there, can you afford to let it sit there for the next 20 years without a mortgage against it and receiving a portion of that income? I don't see how. Maybe you're in a 1% exception that works with, but for the other percentage of people that I meet with, that's not the case. So, to be able to make the point really as best as I can, what I want you to do is you take your mortgage payments, your HELOC payment, if you have it, you take your property and homeowner association and your soft costs, and you add all of that up. It becomes one number that you're spending every month right now. I mean, it's not going to be something that you've never done before, because in pieces every month, these are the expenses that are coming out. And you're going to put exactly something like this, where there's a now and then there's a reverse mortgage underneath it. In the now, this becomes your total overall mortgage carrying costs for the house, which is inclusive of everything, soup to nuts. It's going to have your taxes, it's going to have your mortgage, it's going to have your HELOC if you have it, it's going to have your soft costs. That's going to be your figure here. Then underneath, we're going to talk about a hypothetical that if you had a reverse mortgage, what that would look like. Well, the reverse mortgage, what it would look like, I could tell you what it's going to look like. The monthly reverse mortgage costs, you already figured it out. You already know what the carrying cost is. And the reason you know what the carrying cost is because it's not going to change. Once we pay off your mortgage on your existing house, you're not obligated to make a monthly payment on that. So your mortgage payment, in essence, goes away. What will you be left with? Well, you'll be left with your property taxes, your homeowner's insurance, homeowners association if you have it, and your soft costs. So that's what these asterisks refer to. This would be the only expense that carries over to the reverse mortgage section. So if your expenses with your mortgage was $6,000 here, and you determine that your maintenance and your homeowner's insurance and all of this is $1,500, what's going to happen? These are the only expenses that you're going to be obligated to pay for on a reverse mortgage, because the rest of it is going to be on the reverse mortgage side of it, and a payment is not required, it's optional. Your only monthly obligations that you have to pay in order to keep a reverse mortgage or any mortgage in compliance is to be current with your property taxes, to pay your homeowners association, to be able to maintain the property, And this kind of takes us full circle to what we started yesterday. Why do properties go into foreclosure? Well, it's non-payment. And if you really think about it, it's non-payment over and over again. It's non-payment of your first mortgage and your home equity line of credit. It's non-payment of your property taxes. It's non-payment of homeowners association. It's not being able to maintain the property, which is property maintenance, which another word for it is, I can't afford to make a $40,000 roof repair, and the bank comes by and sees that the house is in disrepair, and then they could initiate foreclosure. So foreclosure comes about as a byproduct of not having enough money. And if you don't have enough money, it's because your income sources are limited and your savings are limited. And if your income sources are limited, or you lose a spouse and that income goes away, and your savings is depleted by paying off your mortgage balance, of course you're going to be in this danger of non-payment for these issues that can cause foreclosure. That's why when I hear people tell me that they heard someone had a reverse mortgage and the bank foreclosed on it, I always just internally think to myself, how can they afford a regular mortgage and not get into foreclosure, but get into foreclosure when they got into a reverse mortgage that doesn't require a mortgage payment? Think about that. It's just absurd. Because if you have a $2,000 payment here and I make your $2,000 payment go away, that $2,000 payment that you don't have to pay on a mortgage could be now used to pay for these other expenses. And if you were getting the money to pay for the mortgage, then how would you not have that money to redirect to pay for your property taxes and insurance or anything else? Net, when you add up your monthly figure and then you look below and you back out the mortgage payment, it's as simple as that. Look at your total obligation now, back out the mortgage payment, and what's left? This box is what you owe every month to the bank. And it's hell of a lot less expensive than what it is with a mortgage. And if you insist on paying off your mortgage to be where this is, well, that comes at the cost of depleting your savings and everything else that we talked about over here. So I try to go into every possible perspective for you to be able to see the point that I'm making and not just be on the front, but show it to you from a future, show it from now, show it with one spouse being available, one spouse not in the picture, income being depleted, savings being depleted. I try to show you from every possible scenario so that you could challenge yourself and begin to think in terms of, have I been selling myself short when it comes to this program, and thinking about a perspective that is just not based in reality. So I hope you really take the time and energy to write these numbers now that you have yesterday's video and you have today's video, and you see what the narrative is that we're going for. And again, this would be the same conversation I would have with you if you were in my office today and I was helping you, and it wouldn't be any different. So if you don't do the exercise now, you're not going to see if this is the right product, and at that point there's nothing else I can do for you. The balance of the days in December that I have different topics, and I'm going to try to challenge and pick the most difficult topics that I know people get stuck on. Some of the ones that just come into my mind are like reverse mortgage and its consequence on inheritance. And some people think that they're not going to have any inheritance left, and that's from the children's point of view. Some parents are worried about that they won't have anything to leave behind. That's from the parents' point of view. And I have a whole host of topics that I want to deal with and address, which I think are the most important. If in watching this video, there's still some reservation that you have about the topic and some of the subjects that are really bothering you and you don't know how to deal with it, or they're concerning to you, and you haven't seen the answer the way you want it in the other videos that I have, which are in the playlist, then reach out to me, whether through an email or put it in the comment section, and I will try to specifically do a video that addresses this. The magnum opus of my videos that I've done, which was on Friday after Thanksgiving last week, came as a result of one viewer watching the video that I had made the day before Thanksgiving, and his comments were very negative, and his views towards reverse mortgage were very negative. So much so that I felt that answering his comment just in the comment section wouldn't do it justice, because there were, I'm sure, other people that have the same perspective. And in answering that video, I ended up doing a video that is 59 minutes and I think 30 seconds long. And that turned out to be one of the best videos that I've done, because I went into like a global view of a reverse mortgage, from the negative amortization piece, the equity stripping piece, the fact that some people think that only the poor and desperate and destitute get a reverse mortgage, and why would you ever get a reverse mortgage if you have money, and who in their right mind would get this product? The idea that you're going to lose all of your future home value. I approached that topic from the clients, the viewer's perspective, and I covered it again from every possible narrative, and it turned out to be one of the best videos that I've done. And I would really encourage you to watch it, not because I care about your view time and trying to do anything like that. I care about you understanding that this program, the reverse mortgage, is now 34 years old. And more importantly, in the last 10 years, the amount of information, the amount of education, the amount of articles, the amount of research by really incredible, qualified PhDs with economics degrees who have no horse in the game other than trying to help your retirement is undeniable. And my piece of it is to bring to the forefront as much information and education that you can, because I understand the hesitation, I understand the reservation, I understand the fear, I understand the discomfort, but we got to get past that. And if we're going to be really serious about your retirement, if you're going to be serious about your retirement, if you're going to care about how the quality of your life and your financial independence is for the next 10, 15 years, if you don't take the steps now, if you don't do the research now, if you don't put things in place now, you may lose an opportunity cost that we can't get back. Right now, we're dealing with 8% inflation. As a result of it, the Fed has began ratcheting up the interest rates. Well, these interest rates have an effect and a consequence on me being able to, or anybody else being able to, do reverse mortgages. It can mean the difference with you getting more money instead of less money. These interest rates and the situation in the financial market that we're dealing with are having a consequence on the housing value. If you think about how much your house is worth, and just to use a nice round number of $1 million, if a house is worth $1 million and you lose 15 to 20% of equity over the next 2 years, that's $200,000 of housing wealth that you have lost. And depending on your age and how far along you are, can you afford to wait long enough for that $200,000 to come back to where it is today? And if you don't take advantage of the opportunities that are available today, and you lose the opportunity for the housing appreciation that you've accumulated, which is your housing wealth, your interest rate ability and opportunity to get more money. If you lose these things, your consequences, the damage to your retirement is going to be significant and profound. And that means you're going to have to tap into your reserves and your investments. And this goes back to this entire conversation of, if you have to reach these things sooner than later, there's implications. There's tax income explanations and implications. There's tax brackets. There's possible penalties. There's withdrawals. There's market participation that you lose. There's a lot of stuff going on. And when you think through just one aspect, which is, I hate reverse mortgages and I would never get it, then how do you deal with this entire big frame of things that are going around? It's like this entire universe of stuff is going over your head and you're dismissing it. And how are you going to be able to, in your mind, deal with all of these consequences? I mean, if you don't want to do a reverse mortgage, God bless you, man. That's okay. There's 10,000 seniors turning 62. There's 10,000 baby boomers turning 62. And guess what? I'm going to be able to help some of them, not all of them. But if you say no to me and you walk away, that doesn't affect me. That affects your quality of retirement. And that's why I'm so passionate about this program and I care about what I do and decided to take this challenge. So the challenge is really to challenge me to be able to push myself and share the importance of this program for seniors and to have this. And I hope that what I shared with you makes a difference. And if it did, if I said to you something that resonated with you, if I said something that you have not heard in all the videos that you've done, this isn't about me feeling good about myself and doing videos. That my mother loves me and that's all the love I need. And I've got enough people loving me that I don't need any more accolades. My care and my commitment is to get this word out and this communication to as many people as possible. If you feel that you know a financial advisor that could benefit by knowing this, if you have an estate planning attorney that could help your clients or other clients with this, if you could share this video and if you took away something new with it and you either subscribe to the channel and you like the video, and if you have requests for something, I'll do it. Again, it's about trying to help the seniors as much as possible and not have them walk away saying, I didn't have the information to make an educated decision. All right, so tomorrow's Saturday. I got to figure out what I want to discuss. I don't want to go heavy on the weekends with the topics like I did yesterday and today, but it's going to be something relevant and informative and informational, and I hope that you'll be with me for the next 30 days. If you like to subscribe, you get the videos. Hey, my sister wasn't even a member, or what did they call them? A subscriber, I guess, until I told her to join, and she did. So now I have 14 viewers. So that's one more than before. All right. Thank you very much. I appreciate you being my client. God bless you. Have a beautiful and fantastic day. And I'll look forward to seeing you on the next video. Bye-bye.